if the U.S. has a hyperinflation, which is a distinct possibility, it will have to tie its currency to a hard asset, and it's not going to tie it to the euro or the yen or anything. It's far too big. What it'll do is it'll tie it to gold, because the U.S. owns gold in Fort Knox, the biggest owner of physical gold in the world. And all these other countries are thinking the same thing. So gold is the monetary asset. That's the real play at the end of the day.
Hi, and welcome to Wealthion. I'm James Conner. The financial markets are becoming more chaotic, and if you need help understanding these crazy markets, consider having a discussion with a Wealthion endorsed financial advisor. You can find out more information at wealthion.com/free. Once again, that's wealthion.com/free. Now on to the show. Chris, thank you very much for joining us today. How are things in New York?
Jimmy, things are, first of all, pleasure to be here. Thanks for having me. Things are nice in New York. It's a cloudy day, but we haven't had, we've had like a very nice fall, very pleasant weather. The leaves are turning. Actually now it's like, I think they're at peak around New York City. So in terms of the colors, very, very nice, beautiful.
Yeah, New York is a great place to be in the fall time. I love going there.
Yeah.
So I was going through my notes this morning and I thought, man, there's not much going on in the world, okay, aside from the fact that we have Google, Microsoft, Facebook, Amazon, and Apple reporting this week. And we also have the non-farms coming out. And then we have an election going on next week. Can you believe all that?
Exactly. Everybody really wants to hear from me for sure with all that going on. I'm sure that. But then I'm like the way top of the list. Yeah, as a distraction, you can maybe listen to me.
And of course, I can't forget the World Series going on too. New York Yankees against the LA Dodgers.
For me. Yeah, so as of now, the Yankees just lost last night 4-2. So they're down 3-0 against the Dodgers. And the Dodgers, I have to say it, do this really annoying dance. Every time they get a hit or they get on base, they put their hands over their head and they do some horribly ridiculous dance, which makes it even worse that they're beating us. So yeah, but it's nice that the Yankees got there, and we were close to a Subway Series, which would have been fun too. So anyway.
So I don't know if you heard this, but the average price for a ticket to a Yankee game for the World Series is $2,000, and even the cheapest ticket in the 400s is $500 minimum. And if you go down to the 300s, you're looking at $1,500.
Yeah. I mean, yeah, I don't know what to say. Like again, I mean, I think it's amazing. Well, you have, I think part of it really is this big asset price inflation. So, as we know, a lot of New Yorkers are in the markets, work on Wall Street or what have you. And they own assets, they own stocks and houses and things like that, and with the rates being, they've gone up, but historically low and just on their way down now. The asset prices and also, frankly, the huge amount of fiscal stimulus that we've seen has also found its way into the system. So with asset prices going up in a place like New York, where people own stocks and are involved in selling stocks as brokers and things like that, and bankers and whatever, there's just, it's amazing. It really is an indication of just how much money has been really pushed into the system.
So let's talk about that in a little more detail. Gold is a great investment to own during these inflationary times. It's up over 30% on the year. In addition to inflation, what else is driving the gold price?
Well, I think that right now what's a big deal is, I do think that rates are coming down. And I think that there was a general sense that as rates went up, the opportunity cost of holding gold, which yields nothing, also went up. And so there were outflows out of gold-backed ETFs. And so the gold price did hang in there, notwithstanding these really huge outflows out of gold-backed ETFs. And what we're seeing now is that with rates starting to decline with the first Fed rate cut and a view that there will be some more, we've actually seen inflows into gold-backed ETFs. And I think that that's really the key now. of what's driving like the day-to-day move in the gold price is this increase in or this purchasing of shares of gold-backed ETFs, which then go out and buy the physical gold, and that increases demand. And so I think to the extent that rates continue to decline, we'll see flows into ETFs and gold will go up.
So gold is trading around $2,700, $2,800 an ounce. Do you have a target price for gold? Where do you see it going a year, 2 years out?
I mean, I just think that there's no specific target price, but we're in an uptrend now, and these inflows into gold-backed ETFs, I think, are very significant. So I think that we will continue to see these flows continue, and as long as they continue, the price will go up, and there's no reason why it couldn't go to $3,000 or more from here. That's a relatively small move in the context of what's happened historically in terms of just from a percentage move perspective. To go to 3,000 isn't such a big deal, and I do think that that's in the cards next year.
$3,000 is a chip shot. I was hoping you were going to say $4,000 or $5,000.
I mean, it's one of those things where I've been involved in this for so long, right? Where I've been studying and analyzing and looking at the gold price every day of my life for the past 15, 16 years, whatever it's been as I've been doing this. And the concept of 3,000, again, for someone like me is like, I never would have thought, because that's really an all-time high. 2,000 15 years ago would have been something that we would have said, oh yeah, that's a ways off. So 3,000, yeah, it's one of those things. It's a mindset, but for sure, I mean, when you look at it in the context, could 4,000 be in the cards? Sure, why not? I mean, but when you look at it again in the context of what Bitcoin does on a monthly basis, it goes from 60,000 to 70,000. So a similar percentage move for gold, from here would be, I guess, something like 3,500 or, something like that. So, so why not, I guess, is a response to that.
And so you don't have a target price per se, but what about, what price do you use to value a gold producer?
What we do is, we put in the model the spot price. So we assume that the market is valuing these stocks based on the spot price of gold. And so, and then in terms of how we position the portfolio, we try to figure whether or not we are in a bull, if we're in an uptrend, which stocks would do better if the price of gold were to go up, and which stocks would do worse if the price of gold would go down. And so, to the degree that we think that we're in a bull, we'll price the stocks at the spot price, but we'll, we can stress it. We can just plug into our models higher gold prices and see which ones would do better in that scenario. And so, like, one example of that, say, is Anglo Gold, which is a big producer. It's relatively high cost, but it also has debt. So we're valuing it right now based on the 2,750, but I'll stress it in my models at 3,000 and see what it does look like, and what it would trade at those levels. So we use spot, but we play around to see where they would go in certain circumstances.
So I want to ask you about a few specific names, but before we do that, I want to spend a little more time on inflation. And we started this conversation by talking about how much tickets were to the World Series, but it doesn't matter if you're talking baseball tickets or tickets to see Taylor Swift. The prices of everything have exploded here in recent years. Inflation is at 40 or 50-year highs. And because we're seeing this increase in inflation and also this move in the gold price, are you seeing, what sort of flows are you seeing into your funds?
We've seen, since we've actually seen the flows, so for most of the year, they were pretty flat to negative. And it seems like they've trended kind of in line with the flows into and out of the ETFs, the gold-backed ETFs like the GLD and the IAU. But like on a more muted basis. So the beginning of the year, small flows out, then they kind of leveled out, and now we're getting small flows in. and again, kind of in line with the market's broad interest. I think the U.S. market's broad interest or disinterest really at the beginning of the year, and now interest in gold.
And how large is your fund now in terms of AUM?
The fund's around $400 million now. Is our open end long only gold fund. We have a couple separately managed accounts, which are like 30, 40 million, and we also sub-advise for a German fund, which is around a German long only gold fund, which is around 60 million.
And I'm surprised, given the move that we've seen in gold this year. It's up over 30% on the year, but why aren't you seeing more flows or more interest?
I just think it's still really muted in the U.S. I mean, I think that although we started to see flows into gold-backed ETFs, they've been, it's a positive trend, but it hasn't been a huge spike upwards. And I think that the broad market's done really well. We see, gold's up this year, but Nvidia's up a lot more. You know what I mean? And I think that the stock market generally is working. And so when the stock market's working, like again with the guys who are listening to this, like if the advisors call up their clients and say we're thinking of starting a position in gold. I think that the general kind of view from someone, a wealthy individual who's owns a business or something like that might be, well, why would you do that? The stock market's doing well and it'll probably continue to do well. So I just think it's not so much that that there's a huge disinterest or I guess it's not so much that people don't like gold, but it's just that it's not that they hate gold. It's just that they don't really think about gold. And I think that's still the case. So I think that we'll have to see maybe interest rates decline more, maybe, and that lure of the cash become a little bit less. And so advisors say, okay, let's put some of your assets from cash into something else. So that might happen. A recession would help it too.
So it's basically because there's more interest in other asset classes that are doing better than gold is.
I think so. And especially the broad stock market, which is doing really well. And so that's where, Americans' interest. I mean, every American knows about the stock market every single day. And when it's doing well, and that's where most of their assets are, that's what they think about. And to be even, for an advisor to say, how about thinking about this other asset, I think is risky for them. You know what I mean? Even professionally. So I think there's just this lack of interest, because the other asset class, especially stock market, are doing well.
So one of the things that really stands out to me is inflation, right? And it's in spite of what the government says, they say, it's approaching our 2% target rate. I disagree totally. I think inflation is not going away. I see it picking up again in 2025. The longshoremen on the West Coast just negotiated a 32% pay increase over 6 years. The East Coast longshoremen negotiated a 60% wage increase. We have the Boeing mechanics currently on strike, and this is all going to trickle down to me and you in the coming year, right? And that's only going to result in higher prices for everything. So what do you think this does, 6 or 12 months from now to the gold price?
Yeah, I mean, I think that if we're in an environment, I think that like almost a best case scenario for gold is like the stagflationary type of environment, because I think or an environment like you're mentioning in which, the economy's, weakening somewhat, rates are coming down and inflation is really sticky. So in that type of scenario, I do think that people start to say, well, wait a second, my cash is yielding less and it's also purchasing less because of inflation. So that's when they start to realize, wait a second, I need another asset class. I need something that will hold its value over time. And I think that that's the really good scenario for gold. So I think that in that type of environment that you're talking about, because we are seeing the economy start to slow and in fits and starts, we are seeing the jobs numbers, weaken. Now they go up and they go down there and they're kind of seasonally adjusted and that kind of thing. But we have been seeing a weakening in the job market, and we have been seeing unemployment go up, partly because we haven't been seeing as many jobs added and partially because people are coming back into the labor force. So I think that if we are in that environment that you talk about where inflation goes up because of labor pressure and jobs in the broad economy start to weaken a little bit, like then people will start to freak out a little bit and say, just, let me have some gold.
Hi, everyone. I'm one of your hosts here at Wealthion, Andrew Brill. In these weird economic times where the market is up, then it could go down, a lot of people calling for a correction. Some people think it's just going to keep going up. But if you need help being financially resilient, head over to wealthion.com/free, and we'll give you a free, no obligation. We don't expect anything from you. We'll just help you evaluate your portfolio and let you know what we can do to help. Again, head over to wealthion.com/free for a free, no obligation portfolio review, and let us do the heavy lifting for you.
So we also have to talk about the fact central banks have been very aggressive buyers here in the last few years. I believe they're acquiring around 25% of all production. Why have central banks been so aggressive in acquiring gold?
Yeah. I think that what's happening is it was just a huge, just monumental shift. I've spoken about this before, but it was really, really a huge shift in the whole paradigm when the United States and Europe confiscated Russia's reserves, Russia's U.S. dollar and euro-denominated reserves after it invaded Ukraine. And so, Russia thought that they were these were assets that they had that they could use in a pinch, and that's what their reserves were for. And then all of a sudden, boom, with a push of a button, essentially, they're gone. And so I think that other countries are starting to see, like they saw that, and especially China, but not just China. And they're saying, okay, like, how can all of my reserve wealth, our entire nation's savings be placed in an asset which can be taken away just with the push of a button? And so like conceptually, I think they're talking about this and going, okay, like this doesn't make sense. So what can we have that can't be actually taken away from us? And gold is the answer. I mean, that's the one. It's in a vault. It's why it's been money for as long as people have had money. So that's a huge deal. And I think that will continue to be like a baseload source of demand for gold.
So you're bullish on gold. I got to ask you about silver now. It's trading, where is it? I think around $34-$35 an ounce. What are your views on silver?
I think silver is, it's going to do well if gold has a run. I think what'll happen is, like, my view is that it does have a lot of torque because silver has an even bigger baseload source of demand. So I was talking about gold having that baseload source of demand from central banks, sure, but that could go away. Silver's baseload source of demand is industrial, from solar panels and other industrial uses, like it's antibacterial, that kind of thing. So that's over 50% of its demand has that solid baseload, and it's growing. And so the marginal source of demand is from investment and like investment demand. And I think it really is more of a retail investment demand. So central banks, and part of the reason is that, if you're the Chinese central bank and you want to own an asset which can't be confiscated and you're looking around, you need a lot more silver at $35 an ounce than you do need gold at $2,800 an ounce, just physically to be able to store, to be meaningful. So I think that, and that's part of the whole analysis. So I think that I think that the central banks, again, are going to stick with gold. But I do think that the retail, when they see gold moving, will move into silver, and they'll move into it quickly. And because there is that base load 50% or higher source of demand, it'll make silver run really fast and like kind of catch up to gold, kind of as we've seen in the past couple of weeks.
So we always hear about people talking about this increase in industrial demand for silver, and how much is growing. But in spite of that, it doesn't really, sure, silver's at $35, but the all-time high is $50. That was set back in, when was that, 2011, 2012?
Yeah.
So in nominal terms, what's the real price? Like maybe it should be 75 or 100.
Yeah.
Why isn't the silver price significantly higher than where it is right now?
Yeah. I think I think part of it is just that there's like a lot of silver is produced as a byproduct. So to the extent that some gold mines did shut down or when the gold price declined, that didn't really happen for silver because silver is produced as a byproduct of lead and zinc. So I think that the demand stayed pretty constant. And I just think, again, that notwithstanding the fact that there has been an increase in industrial demand, I mean, one thing actually, it's not a huge deal, but there has been a decline in demand. Photography was a big source of demand actually back 15 years ago because that was used to develop photos, and now that's not being done anymore with the advent of iPhones and things like that. So that's a small kind of lack of demand. And then, the other thing is that notwithstanding the increase in industrial demand, we still haven't seen the investment demand. And I do think that it's like gold gets the first degree of investment interest from institutional buyers who can buy a lot of it. And then my sense is from my having done this for as long as I have, the real move in silver was when it was like a retail, I don't have any data on this, but just from talking to people, whatever, it's like it was the retail move. It was the idea of someone saying, okay, I can either spend $3,000 and get one coin at Costco, or I can spend $3,000 and get, 80 coins, or, then it was like, okay, $3,000, I can get 75 coins, 70 coins. And it just feels like it's more. And that, again, drives the price up as the retails just buys up the physical silver. So I think that for it to really move, I think gold will move first, and then you'll have to see it trickle down into retail in the US, and then it'll cause it to catch up. That's my sense.
So it sounds like you're really bullish on gold, not so much on silver. Is that correct?
Not in the short term. I mean, I like gold better than silver. I do, because it is the monetary metal. I mean, at the end of the day, the real play for a gold investor or for a precious metals investor is a significant debasement in the currency. And so the real play really, and, I spoke this before, is just the idea of the U.S. having a scenario like Argentina. And when Argentina had a hyperinflation, or when it has its hyperinflations, it ties its currency to a hard asset. What it does is ties it to the dollar. If the U.S. has a hyperinflation, which is a distinct possibility, it will have to tie its currency to a hard asset, and it's not going to tie it to the euro or the yen or anything. It's far too big. What it'll do is it'll tie it to gold, because the U.S. owns gold in Fort Knox, the biggest owner of physical gold in the world. And so, and all these other countries are thinking the same thing. So gold is the monetary asset. That's the real play at the end of the day. But I do think that silver will have its moments.
So inflation hit 300% last year in Argentina. Do you see that happening in the U.S.?
I was looking, there's something called the Committee for the Responsible Budget, I believe is the name of it. And it's this bipartisan committee. And they did an analysis of all of the promises and things like that both Harris and Trump have made on their campaigns and what they've written in their statements, whatever their platforms. And it's like under both of them, there would be an enormous increase in the deficit over the next 10 years or whatever time frame they mentioned in their report. So, in the realm of trillions and trillions of dollars of an increase in the deficit. So, that's the whole situation. I mean, we've also seen rates, so it's we've all heard this story before in terms of the spiral. Rates are really high. The interest on the debt goes up. And then there will be pushback from the market at some point when the borrowing just continues and continues and continues, and both parties are pushing for increased borrowing. And when you have to borrow more, you have to pay more to borrow. That's just how it works. And so interest goes up. And yeah, I mean, it's a distinct possibility that the United States is in one of those inflationary cycles, which eventually leads to hyperinflation, like happens and has happened all over the world when you have fiat currencies.
Especially if you see unions negotiating 30, 40, 50% pay increases like we have seen in the last 2 years.
Exactly. And I think something else to remember also and to think about, Jimmy, is just that what we've seen actually is that from a payroll perspective, the cyclical employment has been declining. So meaning like industrial jobs and things like that. Non-cyclical has been increasing. So that's essentially government workers. So people in education, healthcare, defense, other, federal jobs, things like that. And that's what tends to happen too in places like Argentina, is that when the economy weakens, they just hire more people in government-backed jobs. So you have the longshoremen getting paid more and things like that. And then you also have government jobs continuing to sop up a certain amount of demand, but it's in the context of a weakening broad labor market. So it's this weird kind of it's artificial, and it does lead to like a stagflation, and then eventually a potentially hyperinflation.
And that is exactly what's happening in Canada.
Yeah. I mean, yeah. I think the Canadian dollar has been weakening. I mean, I think that's one of the, first I've seen just one of the weakening. It has a really weak trend to it. And yeah, I mean, I think that the Liberal government in Canada, it's the Liberal Party, right? That's what it's called, right? Yeah. I mean, it's been, from my understanding of it, it's been a huge mess. It's more down the road than the U.S. is in terms of that eventual conclusion. So, yeah.
Yeah, and just to clarify, we actually have two parties running the country now. We have the Liberal Party, but they have a coalition with the Socialist Party, referred to as the NDP. Right? And so these two parties together have really driven this country into the ground. And but I bring it up because you made mention of the fact that in a country like Argentina, what they do is in a declining economy, they keep growing the number of people that are employed by the government. And that's what this government has done.
Exactly. I mean, and it's the playbook, you know what I mean? It's just the playbook of how these things work. And it's in the U.S. too. We're saying I believe that it's happening in a much more severe way in Canada. I mean, it is what it is at this point. And it seems like, there is pushback for sure. We'll see what happens in terms of, like you said, there's a little thing going on next Tuesday here that you might have heard about in Canada. So we'll see what happens then, a week from today. But so there is some pushback, but from the electorate. But it's like once you're on that path, it's hard to get off of it.
So I want to talk about equity valuations now. Okay, and one of the reasons why we invest in gold equities is because we want the leverage. Okay, we don't want to make 30%. We want to make 60 or 90% or whatever the number is. And we both know mining is extremely complex. There's so much to consider. Metallurgy and grade and size and geopolitics, of course, and this impacts a company's profitability. But I want to look at a couple of names now, and I'm going to say Newmont. It's the world's largest gold producer. They just came out with a disastrous Q3, and one of the things that really impacted them was inflation. Topic that we've already discussed, but their all-in sustaining cost was $1,600 an ounce, up from $1,400 a year ago. What are your thoughts on Newmont and the quarter that they just reported?
Newmont, like you said, I mean, it was disastrous, and it actually, like disclaimer, it's the biggest position. That and Agnico are the two biggest positions in our fund. And it was disastrous messaging more than anything else. And the management really should be called to task on the disastrous messaging that they gave in that quarterly report. Because what happened was they came out with they put their press release out at night, Wednesday night, and then Thursday morning it actually traded in Australia just on that, because it trades a lot in Australia through the Newcrest deal, and it was down around like 5%, I think, because of that. Because, like you said, their all-in sustaining costs were higher for the quarter. Then in the morning, it traded in the U.S. again down around 5%, maybe even less than that. Gold was up a little bit, so 3-4%, that kind of thing. Then on the call, which is 11 o'clock Eastern time, they just bungled the messaging on the call, and I think that they need to come out on the street and say that they messed up with the messaging, and that the message is still the same. I mean, the big picture is that the reason that the costs were higher for the quarter was primarily because one of their mines, which was shut because of a fatality actually in Argentina, Cerro Negro, is ramping up, and so it's not at full production. Another mine that was acquired from Newcrest called Lihir did maintenance on their plant, and so their production there was a lot lower than it should have been. And then their non-core assets, which are held for sale, which are going to be, which are in the process of being sold, so they will be sold within the next, actually all 6 of them, because none of the sales have closed yet, even though 2 have been announced. Those were actually very high cost too. And so when you take a step back and say, okay, like the Lihir will be the maintenance will be done. That'll be at a full run rate. The costs will come down. Cerro Negro hopefully will have ramped up from the startup process. The costs will come down. And then when the non-core assets are sold, the average costs will come down. And the story is still that next year, when all of this is done and taken care of, it will be in the lower half of the cost curve, of the all-in sustaining cost curve. So I still think that that's the story, and that's what they need to come out and hit the road and talk about. But that was a huge bungling of the message, and I think what it tells you more than anything is not so much that the costs are going up so much, it's just that the market is really spooked by the concept of costs potentially going up. So we'll see at the end of the reporting period. So like, they were one of the first to report, so we'll see Barrick come out with their cost, and Agnico, I think that's important, Kinross. These will be important ones, which have a wide range of assets, open pit, underground, really all over, except for Agnico, like all over the world. So we'll see what the cost trends are. But that did spook the market, and they didn't do and they also brought their guidance down for the year on the call and not in the press release, and that spooked the market. So it was like, and again, it's because of the Lihir, which had the maintenance, and then another Newcrest mine, which they called Brucejack, which they need to do more drilling on to get a better sense of the deposit. So this is, again, it's a long way of saying I think this was Newmont specific, and there's a messaging issue, but because of that, I think the market is like spooked about costs.
So, and just to provide a little more clarification for our audience, it was up 30% on the year. Now it's only up 15% on the year versus the GLD, which is up 30%. So I want to ask you about Barrick now, because Barrick is the second largest gold producer in the world. It's up 10% on the year. Okay, so which is shocking. What are your thoughts on Barrick and why the dismal performance?
I think it's really interesting. I mean, I think you do have to pick your spots within the sector. I think Barrick, they've had, again, it's like they've had issues in terms of their costs going up, as you say. And they've also had issues in terms of their messaging, and in that, in that like they don't have any growth, and they are very reluctant to do deals. And they're also, their growth is in, they're building a big project or they aren't building it yet, but they will likely announce that they're going to start building they've been talking about it a lot, building a big project in Pakistan. And so you're like, again, multi-billion-dollar investment. So I think the market's just saying, okay, you guys aren't really willing to do acquisitions. You're not growing. Your costs are going up, and you're allocating your capital to a big project in a place where there are no mines that are owned by Western companies that I can think of, and I don't think there are any. So I think the market is kind of questioning their strategy, and it's also seeing that the costs have gone up and have been trending upwards. So it's like, it's now, question, Jimmy, is, are you going to mention Agnico next, which has done really well?
Well, yes, and I just want to provide. I'm glad you brought that up, because I brought up Newmont and Barrick, which are both having abysmal years. Yeah. But then at the other end of the spectrum, you got Agnico, which is doing extremely well. It's up 60% on the year. Yeah. Kinross is up 80%. IAM Gold is up over 100%. So we have this very big divergence happening within the industry. And to your point that you made earlier, you got to be very careful on your selection.
You have to be careful. Yes, actually. So Newmont, again, so Agnico's our biggest position now because Newmont had the pullback. So they were kind of like the same size. Now Agnico's our biggest, done really well. And they have an excellent strategy. And they execute consistently. Their mines are in Canada, mostly, one mine in Finland, one mine in Mexico, one in Australia, but really their base is in Canada. Great team, been around for a very long time, great culture there, and very solid. Again, we still have the feeling that Newmont is creating that type of company with the Newcrest acquisition, so we're betting on that. But again, it was like, it's very, very frustrating what happened last week. But Kinross is, Northern Star is an Australian company, which has done well, and that's a big position for us. And Kinross is also a big position for us. And that one that one had its moments where it had a mine in Mauritania. It has a mine in Mauritania. There was an issue with the government there wanting a bigger piece of it. They also had mines in Russia. Those mines eventually, they were able to sell those quickly, which was smart. They moved quickly. They sold them right after Russia invaded Ukraine. And then they bought a deposit in Canada, which didn't have a resource, and the market questioned that, called Great Bear. But they've proven themselves there. So that one, I think, has a lot of runway, generating free cash flow, paying down their debt, buying back stock. So you really have to pick your spots, and Barrick is a smaller position for us now because we are questioning their strategy to some extent. Newmont, again, we have to figure out whether or not the management is capable of executing and telling the story. But they're really all over the place, and that's why hopefully you'd want to hire us to manage the stocks.
Right, and I think one of the takeaways I just got from what you said is the importance of being in the right country, because geopolitical risk is something that can really negatively impact a stock price. And you just talked about Barrick going over to Pakistan, Kinross. Where was their big asset? Oh, you said in Russia. And then, of course, First Quantum. It's not a yeah. And then, of course, First Quantum, they're not a gold producer, but they had their largest asset, effectively stolen, which is in Panama. Yeah. So Agnico, 75% of their production comes out of Canada. So once again, jurisdiction is very important when it comes to mining.
Exactly. And I think that part of the reason that it's so important is because, we as portfolio managers of a gold mining fund have to figure out which is the best, which are the best assets and which are the best managements. But we also have to try to figure out where the generalist will go, right, when they do become interested in gold. And I think that, again, just, having to analyze all these different stocks, it's the same thing. It's like if you sometimes you see things and you immediately say within a stock a certain characteristic and you say, yeah, forget it, not going there. Like I could look at something and say, yeah, it's a big development stage project. It's going to need huge amounts of capital. The market's not there yet. I'm not even going to really pay attention to it. Or like you're saying, the metallurgy is an issue on this. I know the market will never get behind the metallurgy. They need to use an untested technology. They need to use some kind of ore sorting or something like that. The market won't get behind it, won't finance it, and I'm just going to, spend my time focusing on other things. So I think the broad generalist investor also looks at the market from that perspective. Like he or she will say, okay, yeah, so tell me about, wow, I should have some gold. And we'll call up a broker and I'll say, like you used to do, Jimmy, you say, so Jimmy, tell me about what I can have. I need something that trades a certain amount per day, has a certain market cap, right? And all that kind of stuff. Okay, well, Barrick, Newmont, Agnico. Okay, well, tell me about, Barrick, blah, 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 blah. It has its growth project is in Pakistan. Like, no thanks, And, okay, tell me about Newmont, blah, blah, blah. Now we think again, a lot of their assets are in Australia, North America. So we think that that'll fit that criteria. But at this point, it's, they messed up the quarter. So at this point, the guy, maybe they'll say, okay, that's an opportunity or not. So whatever. But with like Agnico, it's tell me about it. Okay. Well, where are their assets? Canada. Okay, what's their growth? Well, their growth is in Canada. Okay, great. Okay, so yeah, just give me Agnico. And I think that that's, we have to assess that too, in terms of where the market will go. But that being said, there is a price for everything, So like, one of a big holding for us too is Endeavour Mining, which has all of its assets in West Africa, but it's trading at a 25% free cash flow yield off of next year's free cash flow once they bring these two mines online. So it's like if those assets were all in Canada, it'd be trading at an 8% free cash flow yield. So, we think that eventually the market will realize the free cash flow generation from that company and trade it up. So, but jurisdictions is extremely important.
Chris, you've been at Gabelli now for 16 years, and I want to get a sense of how you would characterize this time period right now in the gold space.
Okay.
I know that until the last couple of years, things were quite tough.
Yeah. I mean, what I'd say is that like it's very nice. It's very nice to have this high gold price and really to look at my models and see the company's reports and really say, wow, these companies are really doing really well. They're generating lots of free cash flow. Things are good, like great, some breathing room finally, like you're saying. But we still have days that are extremely disappointing, like the Newmont day last week, where I went home and was like really, I was really disappointed. And, I think some of that is the function of our being in a bear market where I think we're still at like that, like we're coming off of a horrible bear market. So I think when at the end of the day, the message is still the same in terms of what Newmont will be next year and in 2026. But the messaging was botched and the market just says, forget it, and just sells the stock off on the botched messaging. It shows just a lack of confidence that the market has in the sector right now. So we're still not, it's not, happy days are here again. Like I was at the Gold Forum Americas in Colorado Springs last month. And, again, it was that kind of feeling. It was like talking to the companies, lots of companies, all of our holdings, potential holdings. Like things are good, actually, for the first time in a long time. But it wasn't a lot of like, bottles of champagne and cigars being smoked at the bar. It was still, pretty pretty sad in terms of the stock price performance of lots of these stocks, and just the sentiment was still kind of heavy.
So the gold guys are not celebrating like the Bitcoin guys.
No, definitely not. No, definitely not. We're not there. And but I've seen it there. In 2011, when I went to the Gold Forum Americas, it was I was like, okay, waited, like people are really happy. Again, maybe that was a sign of, because that was the top for a time, right? And I was like, okay, people seem maybe a little bit too happy, but we're like so far away from that at this point. I think that we will get there if and when gold does go to 3,000 and these companies, we finally see a stabilization in costs. I mean, one other thing to think about is the Canadian dollar is very weak. And there are lots of, like Agnico and lots of other companies have mines in Canada. So their costs are in Canadian dollars. So it's at like a 5-year, anyway, you know better than I do, but 72, maybe even it's been close to 71 cents. So very weak. And that's helpful from a cost perspective for companies that have mines in Canada. But same thing's happening now in Australia. The Aussie dollar is hitting like the 65 cent level or around there. Mexico has had a very weak currency recently. So like, those little things also help too, just to throw in there in terms of us hopefully seeing stabilization in cost, the energy price coming down. If Donald Trump is elected and he says he's going to drill, that'll be good for the gold producers.
So your message is this is just early innings in the gold price, and there's still lots of time, even though gold's up 30% on the year. Still lots of time for investors to get involved.
I think that there's a lot of time for investors, to see that, if you want to wait to see a stabilization in costs, and we might see that just within the next few weeks as these companies do report, then maybe then you could buy. But if you think the price of gold is going to stay here and the costs do stabilize, or if you think even better, if the price of gold is going to go up, I mean, there's a lot more to go for in the gold stocks, I think.
Well, Chris, that was a great conversation, and I want to thank you very much for spending time with us today. And if somebody would like to learn more about you, or maybe get your thoughts on what's happening within the gold sector, or learn about the Gabelli Funds, where can they go?
Well, I did this last time and only one person emailed me. I'll give you my email, cmancini@gabelli.com. You can email me. And I'd be happy to get back to you. And also Gabelli.com is our website. So all of our information's there.
I'll make sure I get my wife to email you.
Thank you.
Chris, once again, thank you.
Okay. Thanks, Jimmy. Good talking to you.
Well, I hope you enjoyed that discussion with Chris Mancini on gold and how it can benefit your portfolio. If you would like to learn more about gold and how it can add safety and diversification to your portfolio, visit our sister company, hardassets.alliance.com. Hard Assets Alliance is a trusted platform that's being used by over 100,000 institutional and retail investors to buy and store physical gold. Once again, that's hardassets.alliance.com. There's a link below in the show notes. Don't forget to subscribe to our channel and give us a like, and also share it with somebody else. And by all means, leave a comment below and tell us what you liked or didn't like. If you want to check out more content, look at this video now.